Hi, Dan Kurz, DK Analytics. It is June 23rd, 2017. Thanks a lot for tuning in. Today we're going to discuss cryptocurrencies or cryptos. Are they really currencies? And are they really an investment or just a pure speculation, especially at current valuations / market capitalizations? The decentralized blockchain, so-called cryptocurrencies, have been on a mind-bending tear, up in some cases tenfold or more since the beginning of the year. Just incredible. And they've gained an aggregate market cap as led by Bitcoin and Ethereum of in excess of $100 billion currently, this being June 23rd, 2017. Our thoughts on these currencies when they were grantedly at substantially lower valuations than today, that is, speculators could have made a hell of a lot of money. But our thoughts here, which we put into bullet points as to these so-called currencies and their valuations, harken back to prior comments, especially also in post 17. We'd like to go through the list, a laundry list of sorts with you, not because we have a monopoly on the truth by any means, heaven forbid, but because we want to present you with some hopefully worthy verbal food for thought as regards your positions in these, or if you haven't taken any, whether you would like to in these so-called cryptocurrencies as led by Bitcoin and Ethereum. First of all, cryptocurrencies comprise digital fiat. What do we mean? There's nothing behind them in terms of intrinsic value except for the promise to limit outstanding coins. Well, Bitcoin limits it, I think, to 21 million, and Ethereum as well, and others too, but that misses the point in our opinion. And the point is this: it doesn't mean that a Johnny-come-lately or better Bitcoin or Ethereum competitor can't come along and trump the first mover advantage of the currently being established names in this realm, again led by Bitcoin and Ethereum, and then render existing crypto supply constraints moot or academic, meaning if they develop a better mousetrap, then guess what? They might also be leapfrogged, and we do not, in that sense the word, have a constrained supply of cryptocurrency. So this whole supply constraint issue to me is nefarious at best. Contrast this with silver and gold, if you will, which come out of the ground with increasing difficulty, by the way, at between 1% to 2% per annum compared to the above ground gold of stock, and you will have quite a comparative difference. Also, contrast the cryptos with paper money, which initially were linked or backed, even in the early days, 100% to gold and or silver, to above ground precious metals. And this isn't something that, harks back to the very distant past. Consider this. In 1964, the U.S. Treasury dollar stated, quote, $1 in silver payable to the bearer on demand. This is in 1964. Moreover, third point, cryptocurrencies can replicate properties of gold and silver, except for the most important quality of all: they have no intrinsic value. Gold and silver were sought and treasured across the globe by everyone for thousands of years, actually, before they ever even became money. That's the key. they had intrinsic value. Precious metals, as we all know, are rare, aspirational, very desirable, non-corrodable, don't rust, if you will, divisible, can be cut into little units, and substitutable, and very valuable, yet compact, and thus easily transportable wealth. And both gold and silver have been, as mentioned, universally accepted stores of value, and after that, means of payment for thousands of years. Therefore, gold and silver have very well established intrinsic value on their own. That is, before they became money or backed paper money. This is the key differentiating factor. Crypto units, in contrast, have no intrinsic value at all on their own. Fourth point, I laughed at this when I first read about it maybe a year or two ago, and people, especially today, are beside themselves discussing the quote mined costs unquote of various cryptocurrencies. That is, equating the IT labor costs and the power costs that went into creating viable cyber currency systems. Again, I'd argue they're not actually currency systems, but bear with me. But they argue that lots of energy and man hours went into creating those. So that energy and total man hours gives them value, right? In a comparative way, that's why they try to say mined costs to silver and gold. Well, this is just preposterous. It really is. And in fact, huge ongoing cyber currency costs, energy costs, are not only specific to cyber currencies, but all fiat money, e-commerce, e-banking systems incur huge energy costs. In earlier reports, we talked about the massive increase in the IT consumption footprint, the percentage of all millions of tons of oil equivalents of energy that they consume. It's arcing up towards airline or passenger jet-based consumption. Yet all the fiat money that is now, in essence, electronic fiat money that relies on e-commerce, e-payment systems, all these infrastructures and the banks related to them incur huge ongoing energy costs and are an accumulation of large historical energy and labor costs. Yet, has this assured the value preservation of either big banks or the US dollar over time? No. Bailouts might have on the bank side, but those are artificial. But all these costs invested in creating the fiat money, an electronic fiat money-based system that we in essence all use. How many people actually still pay for things in cash, as a for instance? That hasn't guaranteed either the value of the institutions related to it or the dollar. And by extension, it's not going to guarantee values of any crypto transactional units or currencies, which again, we argue they're not very good ones, and we'll get into that. Our bigger point, lots of cyberspace used energy. All the commercial banks, as mentioned, the global money center banks, all the global product development, global internet-based CAD/CAM development and production, all the entire internet or cyberspace activity, commerce, research, education, R&D, like the genetic genome, consume lots and lots of energy, but there is no guarantee whatsoever that any of these enterprises or the products or services that they provide will recoup the spent energy and involved labor any more than thousands of e-commerce firms' sunk costs guaranteed offsetting residual values in either the involved enterprises or the products and services that they sell. And the same holds true for all kinds of endeavors or ventures or enterprises and all kinds of growth industries over time. In fact, most of the growth industries, competitor ranks vanished and disappeared on the grapevine and proved to be a huge misallocation of funds. If you're an investor, very beneficial for the society at large because it drove down costs. But clearly, this argument, this mind cost rubbish about Bitcoins having an intrinsic value thanks to thanks to incurred substantial mining and labor costs is absolute baloney. Contrast this, however, with what real-world mining costs bring about in terms of precious metals mining, and that is indestructible, high intrinsic value silver and gold. Those are what results, and they hold their value over time, their purchasing power, and not much of anything else. Number 5, when speaking of cryptocurrencies, again, I use the word currencies loosely and a bit facetiously here. There's a cost to go from fiat into cryptos and back, a quite substantial frictional cost, in fact. Consider outfits such as retailers that work with razor-thin margins and require a high turnover. You know, the DuPont return on equity decomposition is margins times asset turnover, how many times you sell your asset base times financial leverage. Well, these retailers already operate with razor-thin margins, and this speaks totally against adoption of alternative currencies or cryptos, which again are not, that require an additional substantial 1 or 2% transaction cost to get in and out of, right? That's the margin right there of many retailers. So this is not an academic issue. Point number 6, there's huge volatility and loss potential related to these crypto units. I think units is better than currency. We all know it, we've seen them, and they don't just go up, they also come down with a thump. And if you purchase a Bitcoin or another leading cryptocurrency on day one, as for example today they were trading at $2,732 per Bitcoin. The next day it could be down to $2,200, $2,100. I mean, this is not a store of value. It's not a suitable medium of exchange, most importantly, and thus is not a currency, much less money. Money or a currency requires this. Both buyers and sellers have agreed to a given price with minimal transactions costs, broad acceptability, and transaction value stability, and also a huge commerce capability. In other words, conducting 50,000 transactions a second or something like that, which Bitcoin and the others so far cannot. Again, when one thinks of these minimal transactions costs, broad acceptability, transaction value stability, you want to know what you're buying for how much and what you're selling it for how much. Again, think of retailers' thin margins and or value shoppers wanting to lock in a bargain. You don't want to mess around with the next day and find out that, you know, your crypto unit translated into into paper currencies is up or down 20 or 30%. And it doesn't just go up. That's the point. You want to know what you're buying at what price, or selling for that matter. In other words, so far Bitcoin and the other crypto units really aren't efficient transactional vehicles / currencies, nor is there a foundation in place which suggests they ever will be. Plus, there is no guarantee that tyrannical governments, which unfortunately rule the roost today across the OECD nations, much less developing nations, won't criminalize Bitcoin's use. There's some noises emanating out of America, and surely the Europeans, or the American government, surely the European governments won't be far behind, because they don't want to give up their huge fiat currency powers and wealth, that fraction of a 1%. So that very fact could further dampen crypto's commercialization prospects or potential, especially if the non-SEC monitored crypto offerings, called initial coin offerings, are forced to undergo IPO type of SEC scrutiny. Point number 8. As such, there is, in my mind, in our mind, really zero evidence that crypto units will ever become widely accepted sources of money, or that any first mover advantage coins, so-called coins or units such as Bitcoin or Ethereum or Ripple, will become viable electronic currencies / mediums of exchange. Plus, if, as I said, any do, history shows that often it's not the early names, the first mover advantage. They tend to get pushed to the side by bigger and better entrants that then come out and eat their lunch, which is a huge, huge risk that investors, no, I dare say speculators in these things, should not forget. Crypto units, only viable long-term value in my mind, in our mind, would be garnering material everyday electronic usage credentials, viability, everyday widespread commerce usage. By extension, then, speculators are punting on these hugely volatile, ill-defined, lacking sustainable differentiation, after all, it is open source code, poor mediums of everyday exchange between people called crypto units. And also, they're speculating in crypto units that utterly lack intrinsic value. I'm going to call them overpriced, as a group, overpriced digital husks like corn husks. This isn't an investment, dear listeners. This is a speculation. So cryptocurrencies, point number 9, they embody a bubble, and their valuations are totally divorced from their monetization potential and monetization reality as valid currencies. In other words, a mania. Bubbles happen again and again, as we know, if we watch history, from tulip mania in Holland to the South Sea bubble to the Mississippi bubble to Japan's real estate bubble to the US housing bubble and to the dot-com bubble, where massive capitalizations, yet no revenues, much less profits, of so-called the future is here .coms were based on pie-in-the-sky commercialization stories of millions of eyeball sites, millions of eyeballs on sites, translating into robust and large enough profit and loss to rationalize these insane market caps. Non-monetizable bubble asset claptrap revisited. crypto units. Now contrast this for a moment, if you would, with the following. Digital currency backed by gold. Digital currency backed by gold. Consider, for example, the 24/7 constantly audited outside of the global banking system, hugely important, outside of the global banking system. It cannot be bailed in, all right? Consider goldmoney.com. This is a digitized precious metals money-based source for you to safely deposit your hard-earned excess cash. Your electronic money will be backed gram by gram or ounce by ounce by physical precious metals based upon the current purchase price the day that you send funds. Your paper currencies, they're your dollars, your francs, whatever it is. Your electronic money won't swing in value by up to 25% in a single day, which will make it a relatively stable store of value, especially in purchasing power maintenance terms, which is what sound money is supposed to do. Nothing more, nothing less, not supposed to be a speculation. This is the kind of money that you and your business and the businesses you are purchasing from will prefer to do business in, for it will give them a much stabler medium of exchange with an upward tilt that will protect them, the businesses, and yourself against the ravages of either inflation or debt-based deflation. If you want to play the lottery, well, go play the lottery with money you can afford to lose. But don't do this with money that you need to pay your bills and feed your family, whether you are a consumer or a business. Reliable third-party outfits like Brinks, in this case it is Brinks, with goldmoney.com, which is a venture between Schiff Gold and James Turk on the other side of the Atlantic and his group. Brinks watches over the goldmoney.com precious metal assets, and it hasn't lost anyone's property in over 100 years. And they're going to make sure that your precious metal property, in essence your current account, transferred into gold, into pro rata gold holdings based upon how much you sent in the current per ounce or per gram price of gold, and I believe soon silver. That is going to be there as sure as Brinks has not lost anybody's property for over 100 years. So, in conclusion, why risk investing, I'm going to call it speculating, in hugely volatile bubble assets at this point, at these market caps, that claim to be gold too, when you can set aside your hard-earned fiat currency by placing your savings into a highly legitimate gold-backed account, thereby protecting yourself against, again, the potential upcoming ravages of debt-induced deflation, or how central bankers always respond to the mess they created. The debt-induced mountains are thanks to the money printing and the leverage factor of 10 to 20 to 1. Well, guess what? That inevitably is fought tooth and nail. The debt, the over-indebted-based deflation created by the central banks will again be fought by the central banks as they print currencies into oblivion. And gold has done well in either scenario. In debt-based deflation, it anticipates the coming printing into oblivion activity of fiat money central banks. And I don't think it's going to be any different this time around. And if you have a way to get your cash outside of the current bank system and not be exposed to either monetary inflation, debt-induced deflation, or bank bail-ins, then I suggest that's a heck of a solid way to consider of positioning or placing your cash. Also, as a point of information for declaration purposes, I have a small amount of cash, $200 odd, that I have used to open up my own account in gold money, and you buy a certain amount of the grams depending upon the price, and I get regular statements, and I hope over time, liquidity and income allowing, that I can increase that. Well, there you go. We hope we've given you something to think about. I think this is extremely timely given the peak or near peak values of what I'm going to call speculative assets, bubble valuation speculative assets, namely the cryptos. If you're fortunate enough, smart enough, lucky enough to have them, and you've ridden them up and you've made a lot of money, consider at least bringing some of that home. And when you do so and you go into cash, consider investing that into gold. And by the way, fiat money or paper money used to be backed 1-to-1 by gold or silver. Think back to that U.S. Treasury note not that long ago in 1964, when in fact you could go to the U.S. Treasury and demand silver for that dollar note. I think those days will come again, and this is a great way to consider playing it. That's all for now. Over and out. Thanks a lot for listening. Help spread the word if you like this. I/we would be grateful. Bye-bye.